When selling call options, the least risky scenario is to sell covered calls. With a covered call, you own at least 100 shares of the underlying stock times the number of contracts you're selling. This way, should you get assigned, you'll already have the stocks to cover the sale. The only risk in selling covered calls is that you may lose out on the potential upside. Let's say, for example, you sold a covered call option on Google. Today, Google trades for $2,814. And maybe you decided to sell a covered call option at the $2,850 strike price, expiring May 20th, 2022, and collect $95 in premium, or $9,500 for the contract. If on or before May 20th, Google starts to trade above $2,850, you're likely going to be forced to sell your shares. But remember, the $9,500 is yours to keep, right? But here's the thing. If Google goes to $3,000, for example, or $1 million, well, you lose up on all that upside. So the risk in selling covered calls is that you lose the potential upside in the stock. With naked call option selling, on the other hand, it exposes the seller to theoretically unlimited risk. So we talked about Google before. Today it's trading at $2,814. And let's say you sell a naked option with a $3,000 strike price. As long as Google stays below $3,000, you're fine. The option stays out of the money. But what if it went to $3,100 or $5,000 or $1 million, like I said before? Well, since you sold it naked, well, then you'd have to buy Google from the market at the current price and then sell it to the call option buyer at the strike price. The losses could be disastrous. Let's say Google went to $4,000. The profit and loss would look like this. So you buy 100 shares of Google at $4,000 a piece. So that's $400,000. And then you'd have to sell those same 100 shares of Google at the $3,000 strike price, meaning you only collect $300,000. Well, for this, you'd end up losing $100K. Well, minus any premium you collected, but whoopity-doo, right? At least with a covered call, you already own the stock. So if the stock goes up, then you're covered. You only lose the potential upside over and above the price. Now, you might be wondering about the risks of selling put options. First, you must remember that by selling put options, you agree to buy the underlying security should the put buyer wish at any point until expiration. The risk in selling puts is that you might end up being forced to buy something worth much less than you paid. So to manage the risk, you need to be sure that whatever you're selling a put option on, that it's a quality stock or ETF that you'd be happy to own at the agreed strike price. And once you own it, you can do whatever you like with it. You can even sell covered calls if you want. Let's look at a real-world example. Say we talk about Amazon. Let's say today Amazon's currently trading for $3,271 a share. And you think Amazon isn't going to be moving lower in the short term. So let's say you decide you want to sell a put option with a $3,000 strike price that expires next month, let's say May 20th. Your brokerage tells you that investors are paying $65.70 for this option. So if you sell one put option with this expiration and strike price, you're going to collect a little over $6,500 in income. Now, let's fast forward to the expiration date. Let's say Amazon is now trading at $2,900. In this case, you're going to be forced to buy 100 shares of Amazon for $3,000 each, even though they're only worth $2,900. But don't forget, you've already collected $65.70 for the put option, so it's not bad. And you're really only going to lose if you sell those Amazon shares at a loss.